We start off with the Federal Reserve. Chairman Jerome Powell sitting on the sidelines for now with no rate cut. Let's get straight to our senior economics reporter, Steve Liesman, who was at that news conference today. Steve.
Thanks very much, Melissa. The Federal Reserve left interest rates unchanged, as you know, at the June meeting, but made a major change in the outlook, suggesting it could cut rates in the months ahead, maybe even at next month's meeting in July. The big change is the Fed effectively ended the policy of patience, just as it was born, actually, where it signaled it wouldn't do anything for several months. It took that word out of the policy statement. Instead, it's now emphasizing uncertainties in the economic outlook and said it would, quote, act as appropriate to sustain the economic expansion. Now, remember, back in March, no Fed official forecast a rate cut in 2019. Now, 8 are on board with rate cuts, at least 1 this year, and 7 of those forecast 2 cuts. And Fed Chair Jay Powell saying even those who aren't forecasting cuts, well, they're leaning that way.
A number of those who wrote down a flat rate path agree that the case for additional accommodation has strengthened since our May meeting. Uncertainties surrounding the baseline outlook have clearly risen since our last meeting. It's important, however, that monetary policy not overreact to any individual data point or short-term swing in sentiment. Doing so would risk adding even more uncertainty to the outlook.
Okay, so what's it going to take for the Fed to actually cut? I think it's the thing you guys really care about. Well, Powell made clear the committee wants to see more clarity in just how weak the economy is, and he wants to know how trade talks with China are going to work out. So if the concerns about the economy are proven right in the data, it seems clear the Fed is going to respond. That could happen as soon as July. Melissa, been pointing all week to these events. The G20 meeting with Xi, the jobs report coming in early July from June, and then the GDP report and the other data during the month of July. That's what it's going to take to seal the deal.
I think what you mentioned, Steve, in terms of how many votes were in favor of a cut this time versus the last meeting, that change is pretty remarkable in such a short amount of time. And we are having a great discussion with Fred Michigan on Power Lunch as soon as the decision came out. And he said it's very important that the Fed doesn't follow the markets. But that's what seems, at least from my standpoint, from many other markets participants' standpoint, has been going on since, late last year or so. I'm wondering what your take on that is in terms of where you think the Fed is in relationship to the markets.
Well, I think the first thing, to your first point, Shakespeare wrote, turnabout is Fed play. That's exactly what he said. And it happens not so often, but it does happen. So that's the one thing. The other, it is a sharp turnabout. I've rarely seen it, I have to say, in about 20 years of covering the Federal Reserve. But there's like this big, we weren't cutting and now we're cutting. There's this very weird iterative process going on, Melissa, where essentially the market prices to what the Fed thinks it's going to do, and the Fed prices to what the market thinks it wants to do. So it's like a circle there. And I think the market may have this one right, but it's got to show up in the data. The Fed is kind of like, hey, the market's got some information. I'm not so unhumble that I'm going to ignore what the market's saying. It doesn't mean I'm going to act on it. But it did really make a change in the outlook to kind of meet the market halfway, and we'll see if the data confirm it now.
Yeah, Karen's got a question.
Yeah, so in the past, it seemed to be the Fed really didn't care so much what the market did. And so I'm wondering, now that you say the Fed seems to, have to get some signal from the market, how can you differentiate that from what they're getting from the Trump administration, which I know they try to ignore and have their, their independence be the main thing they like to talk about? How does that fit together?
Look, they can't ignore it, Karen. It's the criticism is withering. It's unprecedented. It's unusual. I think it stiffens their backbone a little bit. They wouldn't mind proving the administration wrong. What's so weird about it, Karen, is how do you prove the administration wrong? You prove them right about their growth outlook. If you get the better growth, then the Fed's going to have been right. What is that? Past perfect tense, something like that? Going to have been right about not cutting rates, or at least even raising rates in December. So, and look, there's at least some chance that happens. The economy is supposed to weaken. They have this 2.1% GDP growth in there. And I think if you start pointing towards a weaker than 2% number with a one handle on it, that's when you're going to be able to say, you know what? For sure the Fed is cutting here. Again, the markets are part of the process. The Fed does not want to leave the market in the lurch and have major adjustments, but it's not going to do it if you're pointing towards strength. And by the way, there's one other interesting aspect here that you guys may want to talk about, which is, does the Fed cut if the market is at or above all-time highs? It's a weird scenario.
That was the other question that came up in our discussion this afternoon. Steve, thank you so much.
Pleasure.
Great
Thank
to
you.
see you. Steve Liesman, our chief economics correspondent. So with the Fed on the sidelines for now, at least, stocks are just not this much away from all-time highs. 10-year yield sinking near 2019 lows. What do you do, Guy?
Well, it's pretty amazing, right? I mean, I was probably the only one that thought that the Fed had to really say everything right, had to be more dovish than they possibly could be, and otherwise the market was going to soften in a meaningful way. And here we are. I think Steve thought we'd go higher, and we're higher today, at least for a day. It's a very impressive price action. We're effectively at all-time highs. What do you do now? Well, you try to put your dogma on the side. Again, I think the Fed is making a mistake. It doesn't matter what I think. And try to focus on the things that have been working. I'll say again, despite my views on the broader market, healthcare has been trading well. I think you stay there, and I think you stay with the mining sector as well. It absolutely concerns me, though, and I'll say it again for the 5th day in a row, that utilities continue to make all-time highs. There's something amiss in my world.
A low rates kind of reaction?
Of course, that's clearly what it is. But, I mean, you can't. I mean, the market driven by utilities, that's problematic.
Yeah.
And real estate. But I think the Fed should keep this in their back pocket. I think they have this for the marketplace. And who's going to short the market knowing that the Fed is going to cut? So now we're at 100% chance. But if there's no cut in July, then you still have the same ability to say, well, there's going to be one next time. They're not raising rates. I think that's the important thing. They're dovish.
Right. Well, closely monitor means we could very well cut, and that I think that was the most important part of the language. If you look at the dot plots, I mean, basically 8 wanted nothing, 7 want possibly 50 basis points. So you have a dynamic here where the market does get everything they wanted, Guy. But I would agree the market has priced in so much good news here. Here's the one part of the asset classes that we see rallying.
Good news in terms of a rate cut.
Exactly.
Yeah.
And to be clear, I don't think rate cuts are good news. I wish the market was responding really to the fundamentals and the top down, not what seemingly is the bottom up. And what I mean by that is, look, for equity valuations, lower rates are just mechanically good. It means your input costs, your discount rate, whatever you do your valuation on, changes the valuation of stocks. They're worth more in this environment, to belabor this point. But here's something that an asset class that actually has been rallying, and it's kind of good news. Look at high yield. Look at credit spreads. High yield is back up to where, if you own the JNK or the HYG, you're back to where we had the blow-off top in Jan of 2018. So in other words, you've seen credit recover all the way back, as if, even if it means that the Fed is basically giving everybody a lifeline, that is a sign that things have healed somewhat, even though I'm not sure they have.
Is that dissonance, though, when you see JNK, HYG do so well, and you've got the 10-year yield in 2019 lows? We've got German bonds 10-year yields a negative 0.25% or so.
Yes and no, to the extent that junk trades at a spread over whatever the baseline is, right? Whatever treasury you choose.
Directionally, I guess.
Directionally, yes. I actually short some HYG. I think the Fed really got it right today, because I feel like, why move when you're going to get a lot more data by July 30? And Steve touched on a lot of it. Plus, all the things, with the G20 and whether we have any kind of trade deal. Also, we'll really start to see earnings. And to me, that's always the most important thing. This is a lot of noise around the most important thing, which is earnings and what are the outlooks for the second half of the year. I think that, to me, is the most scary part. This is as worried as I've been. I feel like you're saying, if 100% priced in, then where is the upside beside just the knee-jerk that day?
The upside is that if the economy does better, then Powell has a little bit of a safeguard so that he doesn't have to raise. So you have the economy doing better, you have earnings doing better, so you're still going to get the market rally. If the economy does worse, then he can always cut. If trade headlines are worse,
there's no scenario where this market goes down. That makes no sense.
There's one-offs.
There always
I
is a scenario where a market goes down.
There's one-offs, but can you put any type of rationality on the bounce that we've seen from 27.22 in the S&P to now? It's positioning. People were so negative on the lows,
right,
and now they had to catch up.
Okay. Is it a pendulum, though,
yes,
where we're too much
People
to the
are
other
still
way?
not positioned the other way. Volumes have been light. Inflation, there's no sign of inflation. The Phillips curve is dead. So you have global inflation non-existent.
So this is absolute Goldilocks, is what you're saying.
This is a
Either
total
scenario,
Goldilocks.
It's all
yes,
good,
you could have
no matter
one-offs.
what.
May I ask this question, and that is, the last time we were at these levels on the S&P 500, how would you characterize the risk environment then versus now? Guy?
It's interesting. I mean, I think the risks are exactly the same. The only thing that's changed is the commentary out of the Federal Reserve. I mean, to me,
And trade.
this entire. Pardon me?
Trade seems closer.
I think it's different.
Well, I'll push back on that, but okay, we can agree to disagree.
but you're
But
saying
I think the only thing that's changed is the Fed commentary.
So when I look at the quote-unquote smart money, and I would say that retail and folks that are long only in the wealth management community and a big chunk, if not the major chunk of the global asset base has actually been relatively bullish. But if you look at smart money, if you look at long-short hedge funds, if you look at guys who are paid to basically assess risk, I think they've been badly short. Maybe not net short, but they've certainly not been long. And if you look at long positioning of long short hedge funds, we're at 5-year lows in terms of net long positioning, which tells me I actually think this could go a little higher.